welcome and hi, welcome back. Today we are going to talk about January effect for our Make Your Money Work segment, and we will touch on diversification and risk management during the smart investing segment afterwards. Alright, starting off with our topic today, January effect. We have chosen 3 stocks traded at Bursa Malaysia to analyze the stock price daily from December 2020 till January 2021. This is a chart pattern that shows the stock price movement for those 2 months for Sunway Berhad, BIMB Holdings Berhad, and Fraser and Nif Holdings Berhad. Now, to compute the expected return, we will use Sunway Berhad as an example. So, stock returns simply compute by today's price divided by yesterday's price minus 1. And then just double click here at its right down corner to autofill. Next, to calculate average return, we use average function, select all the stock returns, and then you will get the answer. Same formula will be applied to the others. Now we shall move to the analysis part of these stocks. Let's see if January effect is still occurring in 2021. Please welcome Ms. Aliya.
As you can see here, the average return for Sunway Berhad in the month of December 2020 was 0.62%, but it declined to negative 0.28% in the month of January 2021. Meanwhile, the average return for Bank Islam Malaysia Berhad in the month of December 2020 was 0.56%, but it declined to negative 0.38% in the month of January 2021. In relation to this, we discovered that the January effect does not take place for these 2 companies, making the efficient market hypothesis holds true. This is because an efficient market is one in which stock prices fully reflect available information. Therefore, the stock prices should immediately and fully reflect the announcement, thus making it impossible for investors to beat the market. Since the average monthly return for both of these companies were negative, this means the investors are not able to generate return for the month of January. While the January effect has been stronger in the past, it hasn't been strong in recent years due to various factors, such as in 2021, more people are using tax-sheltered retirement plans, therefore they have no reason to sell it at the end of the year for a tax loss.
Thank you, Ms. Aliya. How about we now hear from Ms. Kamaliah? Please welcome.
Yes, thank you. Let's now move on to Fraser and Nif Holdings Berhad. Looking at the average return calculated, we can see that the average return on December 2020 is at negative 0.06%, while on January 2021, the average return rises to 0.06%. From here, we can conclude that January effect does take place for FNN Holding Berhad, and it is still possible for January effect to occur in 2021. A well-accepted explanation for this is due to tax planning, where investors sell their shares in December to claim a capital loss on their taxes to decrease their tax burden and thus lowering their stock prices. They will then reinvest in the market in the next year, which will drive up the stock prices. Other reasons include window dressing as well as investors' psychology to start investing at the start of a new year, which increases the share price and enable investors to gain return.
Hello everyone, welcome back to Smart Investing. For this week, we have a special question that we received from one of our lucky guests. So let's hear.
Hi, so my question is, if you were to earn 1 million ringgit, how would you plan to trade it profitably?
Thank you for the question. Wow, 1 million. I think the most important in financing this huge money, wouldn't it be by diversifying my investment? So, diversification is a strategy that mixes a wide variety of investment within a portfolio. While a diversified portfolio can look like this by owning stocks from several different industries and risk profiles, as well as other non-correlated investments such as bond, commodities, and such. It reduces investors' risk from having permanent loss as well as reduce the portfolio's overall volatility. Hence, investors should invest on securities that are not perfectly correlated with each other and respond opposite way to the market influences. The goal is here to aim for the lowest possible standard deviation of a portfolio, which means lower risk depending on the investor's risk tolerance. Diversification also removes unsystematic risks like business risk fully, however, not for systematic risks as they are not diversifiable. I'll invest the 1 million ringgit into various securities. This is to ensure diversification take effects and I will be able to further spread my risk and bring higher return. Hence, I'll divide the amount of 1 million into several funds and combine them under one diversified portfolio like this. Like they said, never put all eggs into one basket. What about you, Nurin? How would you consider investing your 1 million?
Thank you for the question, Iffah. Let me share my opinion from a risk management perspective. When it comes to investing, risk is inevitable as it comes hand in hand with return. I would invest in a large portfolio by maximizing the number of securities because it is inversely proportional with portfolio risk. However, as a number of securities increases, the total risk will decrease until the unsystematic risk is completely eliminated. After that point onwards, total risk will remain constant even as number of securities increases because systematic risk cannot be eliminated. I will also invest in a well-diversified portfolio that has a beta value of 1. In simple terms, beta measures the systematic risk and signifies the tendency of a security or portfolio's return in response to market movements. A beta value of 1 is the most ideal option because it indicates the portfolio's return is proportionate to market return. As a risk-averse investor, I will not invest in a portfolio with a beta value of more than 1 as it implies the portfolio is of high risk. On the other hand, I will also not invest in a portfolio with a beta value of less than 1, despite it being less risky because a low-risk portfolio also comes with a low return, which may not even be profitable in the long run.